Good morning dear learners and welcome you all to the next lecture of my course on financial literacy. We were discussing the module number 8, that is Introduction to Personal Taxation in India, and today in the lecture number 40 we will be going to discuss the various tax deductions available to an assessee under the Income Tax Act. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you in this particular session. In this session, we will be going to discuss the various deductions covered under the Income Tax Act from Section 80C to Section 80U, and we will be also going to have a practical example of the income of an assessee. So, in this particular session, we will be going to understand the different categories and heads of deductions that are available to an assessee under the current assessment year. In the current finance budget of the country, the various deductions that we are going to discuss may have been removed for the purpose of calculating the total taxable liability of an investor or an assessee in the country. But if you opt for the old tax regime which is allowed to the assessee for this particular assessment year, then you can have the benefit of all these deductions that we are going to discuss. However, certain deductions have not been removed in the current year's financial budget also. So, there are a list of category of the deductions, such as in case if any employer contributes to the NPS scheme of the employee, then this deduction is allowed under the new tax regime also. So, there may be various categories of deductions that may be allowed under old tax regime and may be allowed under the new tax regime. So, whatever scheme you are choosing for the purpose of paying your taxes and filing your return according to the assessment year, you may have the benefits of all these deductions that we are going to discuss. So, let us discuss the various deductions that are allowed under the Income Tax Act 1961. So, the first section is Section 80C. 80C is a kind of deductions that we had previously also discussed in the previous sessions of our lecture, where we had discussed it is allowed to the individual and the Hindu undivided family. So, all the assessees who are filing their income and return in the individual form of person, that is the sole proprietorship form of organization, or individually they are filing the return, or they are Hindu undivided family, they all can claim the Section 80C for minimizing their tax burden. The maximum limit of deduction under this particular section is 1.5 lakh. What may be the various deductions that are available? So, here a premium payment into the life insurance scheme, different kind of contributions made into the recognized provident fund, superannuation fund, public deposit fund, as well as purchasing some kind of notified securities and plans of the government such as Sukanya Samriddhi Yojana, or contribution made by individual or HUF for participation in the unit linked insurance plan of LIC mutual fund may also be a part of this particular deduction. Tuition fees paid by individual to any university such as college, school, or other educational institution situated in India for full-time education of any two children may also be allowed under this section. After that, any installment or part payment that is due towards the cost of house property or payment of loan taken for the purpose of purchase or construction of residential house, that may be also included in deduction. Term deposits for a fixed period of not less than 5 years with scheduled bank or post office is also allowed under this section. Deposit in an account under the Senior Citizen Saving Scheme rules of 2004 is also allowed under this section. So, in this section you can claim the contribution made in any of such investment or expenses, and a maximum deduction of 1.5 lakh rupees can be claimed by the assessee. Next category of deduction under the Income Tax Act is Section 80D. So, it is also allowed to the individual and the Hindu undivided family. So, if any person is working on a sole proprietorship basis, or they are situated their business in the Hindu undivided family form of organization, they can also claim the Section 80D deduction. So, in such case, deductions are available for medical insurance premium paid in any mode other than cash. That means, if you are paying the premium or the expenditure in the cash basis only, then this deduction may not be allowed to the assessee for calculating the tax burden, because in such cases it may not be possible for the tax authorities to recheck or verify the reality of the payment of the premium or the expenditure incurred in case of the medical treatment. So, here the maximum limit for the deduction for a normal age, that is the age from 18 years to the 60 year, is 25,000 rupees per annum, whereas for senior citizen it is 50,000 rupees. Deduction for payment by any mode for the preventive health checkup of rupees 5,000 rupees is also allowed under Section 80D. So, these are the limits of the deductions that are allowed under the Section 80D while calculating the total tax of the assessee. Now, the next section is Section 80DD. This is also allowed to the individual and Hindu undivided family form of organization. So, the maximum deduction in this case is allowed for the treatment, or you can say the care of the persons who are dealing with any kind of disability or severe disease. So, in normal disability, an amount of 75,000 rupees is allowed for the deduction, whereas in case of the severe disability, the medical treatment for the expenditure in the medical expenses, the maximum of 1,25,000 rupees is allowed for the deduction. So, for the expenses incurred or medical treatment, including the nursing, training and rehabilitation of a dependent being a person of disability, is allowed under the Section 80DD. Then comes the Section 80DDB. This is allowed for the purpose of medical treatment of specified diseases and alignments of the financially dependent persons on the assessee. This is also allowed to the individuals and HUF, and expenses that are actually paid for the medical treatment of these diseases subject to certain conditions may be allowed for the deduction. So, for the normal age citizens, that is 18 to 60 year, the maximum deduction that can be allowed for the medical treatment is 40,000 rupees, and for senior citizen it is 1 lakh rupees. So, this amount can be deducted while calculating the tax liability of the assessee. Then comes Section 80E. 80E is allowed to the individuals or the beneficiaries such as the spouse or children of the assessee. So, if you are paying any expenses for your spouse or the children, then in the Section 80E you can claim deductions while calculating the total tax liability of yours. So, here interest on loan from financial institution or approved charitable institution for the purpose of higher education of the assessee, their spouse or their children may be allowed for the deduction under Section 80EE. Here, no upper limit for deduction has been set by the Income Tax Act. That means whatever amount you want to claim, and you can provide documentary evidences for the payment of interest on loan for the higher education from any institution or any charitable trust, all that percentage of interest that you have paid will be deducted under Section 80E. Then comes the various criteria that must be fulfilled for claiming the deduction under Section 80E. So, the loan must be taken from any banking company or any approved financial institution or any approved charitable institutions only. That means you cannot take the loan from individual lenders, from your friends, from your family or any other relative who do not qualify the criteria of these particular institutions. So, the purpose of the loan must be educational, as well as the loan must be taken by any of the three type of institution for the purpose of doing the higher education in India or in abroad. So, who qualifies for the higher education? All those who have passed 12th standard, and it may include the graduate and postgraduate degrees such as BTech, MBA, MS or professional courses such as CA, medical or law. So, in such type of professional courses, if you are taking any higher educational loan from these institutions, then whatever amount you pay as interest on loan will be allowed as a deduction under the section 80E. Now, the next section is 80EE. 80EE is only allowed to the individual. That means only individual assessee can claim such kind of deductions. Interest payable on loan taken from any financial institution for the purpose of acquisition of a residential house property. This type of loan may give you this particular deduction. So, the allowable deduction under this category is rupees 50,000, and now additional deduction is over, and this deduction is available under section 24B for interest on home loan of the assessee. So, if you want to build a residential home or you want to buy a residential home, and in that cases you have taken the loan from any banking organization, then the interest paid on such kind of the home loan may be allowed as deduction under section 24B. The maximum amount of deduction under the section 80EE is 50,000, whereas in the 24B the limit of the deduction has been revised under the Income Tax Act. Now, the next section is 80G. 80G is allowed for these different categories of the assessee such as individual, companies, firms and Hindu undivided families. So, we have talked about the different type of assessee in our first lecture of this module. There are 7 categories of the assessee that may include these 4 categories, as well as association of person is there, body of individual is there, artificial judiciary personnel is there. They are also a part of the list of the assessee. They are not included under this list for the purpose of claiming the deduction under section 80G. So, for what the deductions are allowed? Deduction are allowed for the certain approved fund, trust and charitable institution for donation, repairs, renovation and other purposes. So, if you are donating your money for the charitable purposes, for the donation purposes, then you can claim the deduction under section 80G. The various types of eligible donations for the 80G have been discussed here. So, let us understand. In the section 80G, there different kind of donations have been categorized into 4 different groups for the purpose of claiming the deduction. So, first is the category A. 100% deduction is there and there is no qualifying limit. Then there is a category B where 50% deduction is there and no qualifying limit have been told by the Income Tax Act. Then category C is there, 100% amount is deducted, but some qualifying limit of the deduction must be told there. And then category D is there where 50% of the deduction can be claimed and qualifying limit has been discussed under the Income Tax Act for such kind of donations. So, let us discuss the example of all these 4 types of categories. So, donation to a Prime Minister Relief Fund PMNRF and National Defence Fund, in such cases 100% amount is deducted and there is no qualifying criteria also. So, 100% without limit. After that, the second category, donation to Jawaharlal Nehru Memorial Fund or Indira Gandhi Memorial Trust, 50% amount is deducted and again there is no qualifying criteria. in such kind of donation. Then comes the donation to government or a local authority for the purpose of family planning, such as Jila Saksharta Samiti. 100% is deducted, but certain limit has been discussed here. Then donation to NGOs, charitable institution that are approved under section 80G. In such cases of donation also 50% deduction is allowed with certain limits also. So these are the different kind of deductions that are allowed to an assessee under section 80G. Now the next section is 80GG. This is allowed only for the individuals. So only one assessee, that is individuals, can claim this deduction. This kind of deduction is for the purpose of all those individuals who are not receiving any house rent allowance. That means they are not getting any kind of house rent allowance from their employer. So they are not having any support or any kind of facility of residential purposes, and that is why this kind of deduction is allowed to them. So rupees 5,000 per month if they are getting from the employer for the house rent, then they can claim this deduction, or a minimum of 25% of the salary if they are getting from the employer for paying the rent, then this is maybe deductible. Then actual rent paid minus 10% of the total income may be the lower limit of the deduction under this particular case. So under section GG, if you are not receiving any accommodation facilities from the employer and you are arranging your residential facility on your own basis, then for the purpose of payment of rent, if you are getting these amounts from your employer, then you can claim this deduction under section 80GG. Now the next section is 80QQB, that is also allowed for the individual category of the assessee. In such cases, royalty income that is earned by residential individuals, authors for certain specified categories of textbooks, reference books that may have been published in the nature of academic and professional works can be asked for the purpose of claiming this deduction. So if you are earning any royalty income for writing any kind of professional or academic book, then you will be eligible to claim this particular deduction. A maximum deduction of 3 lakh rupees can be asked as deduction under section 80QQB. Now the next section is 80RRB. 80RRB is again allowed to individuals only, and receipt of income by way of royalty in respect of the patent registered on or after 1/4/2003 can be claimed under this particular section. Maximum deduction again here is rupees 3 lakh rupees for the purpose of claiming the deduction under section 80RRB. Next section is section 80TTA, that is allowed to individual and HUF, both the categories of individuals, and it is allowed only for the taxpayer who are below the age of 60 years. Here the senior citizen do not claim under section TTA because they can get a deduction under section 80TTB instead of 50,000 rupees of the limit. So basically the amount of interest that you can get from the saving bank account from your banking companies for this section 80TTA allows you deduction, and up to rupees 10,000 per year you can claim deduction if you are below the age of 60 years, and if you are from the senior citizen group, then you can ask this deduction under section 80TTB. Now eligible interest may be from the various interest income from the banks, cooperative banks and post office of the various institutions where you have invested your money. Interest that are not covered under this particular deduction are interest from fixed deposit, interest from recurring deposits, interest from corporate bonds and NBFC's account, that means non-banking financial company account. So if you are earning interest from any of these sources, they may not be eligible for claiming deduction under section 80 TTA or 80 TTB for the senior citizen. Now TTB is for senior citizens and this is for individuals and HUF. So interest on deposit in case of the senior citizen is allowed as the deduction under this case. Here if you have opened any saving a bank account, fixed bank account or recurring bank account with the bank, then up to rupees 50,000 is allowed as deduction to the senior citizen under section 80 TTB. Now what interest is covered under section TTB for senior citizens? So interest from saving bank account, interest from fixed deposit, interest from recurring deposits, interest from cooperative banks and interest from post office savings, that is the FD accounts opened with the post office may also be allowed as a deduction up to rupees 50,000 for the senior citizen. Here the interest from companies, that means if you have invested your money into company and corporate deposits, from your corporate deposits you are earning any interest, then that will not be allowed under this particular section. Interest from bonds or debentures, if you are earning interest from your long term investment and you are claiming it under this particular section, then it will not be allowed for the deduction under this section. Now the next section is section 80U. So the SSCs who are eligible for claiming deduction under this section is individuals only. Only individuals can ask for claiming their deduction under section 80U. So here for the purpose of any person, for the purpose of treatment or medical expenditure, you can claim the deduction under section 80U. So persons who at any time during the previous year is certified by the medical authority to be a person with disability, and for treating that disability they can claim these deduction. The maximum limit in such a case, there is a normal disability, then rupees 75,000. In case of severe disability, the limit have been increased to 1,25,000 rupees. So these are the various sections, that is from the 80C to 80U, that are allowed to any SSC as per old tax regime. The maximum of these deductions that we have discussed here is not included in the new tax regime. That means if you opt for new tax regime for filing your taxes, then it may be possible you will not be able to claim any of these deductions. There only 3 to 4 some of the deductions have been included for the purpose of calculating the total taxable liability of the assessee. Now let us understand how the computation of income is done for the SSC. So income from all the heads of income that we had discussed in the previous lectures of this particular module, that is salary, then income from house property, income from business and profession, and income from other sources. All these different types of incomes are added together for knowing the total income of the assessee. After that, some adjustments can be made, such as clubbing of income must be done. If you have any minor child with you who is earning sufficient income that may be discussed under the Income Tax Act to come into the taxable liability, then their income must be clubbed with your income. If you are a parent of that child, then clubbing of income, in the clubbing of income you will add those income into your income only. After that, set off and carry forward of losses must be done. That means if you have any loss in the case of the business and profession or capital gains, then you can set off those losses from the same head or any other head prescribed under the Income Tax Act, and you can also carry forward the losses for the next coming years of your tax filing. Then deduction of the set off of losses are done. After that, you will come to the total of gross total income. After calculating the gross total income, the deductions that we have discussed here under the old tax regime, that is from 80C to 80U, if any of these expenditures or investment is made by you, can be claimed for the purpose of calculating your tax liability. So these deductions needs to be claimed here by the assessee for ascertaining their tax burden. Finally, after deducting the different deductions that we have discussed here, you will come to the sum total of taxable income of yours. Now, this taxable income will help you to know your total tax burden for the current financial year. So, according to the tax slab of the old tax regime of the current financial year, you can now be able to calculate the taxes for the individual Hindu undivided family. Now, let us understand this with the help of an example, that the procedure of the computation of the total income. Suppose that here we have taken a practical example for the purpose of explanation. Suppose that if Mr. Raj, for the assessment year 2025-26 and previous year 24-25 is having the following sorts of income, then how we will be going to calculate their taxes. So in such case, suppose that if his salary is 10 lakh rupees, income from house property where he is having a loss of rupees 50,000, long-term capital gain of 1 lakh rupees, income from other sources is from 50,000, wife's FD interest which is clubbed in the income of Mr. Raj is rupees 30,000, short-term capital loss which is brought forward from the previous year is 40,000 rupees, and he is also making some contribution to the LIC policies and he is paying a premium of rupees 1 lakh rupees, and he is also claiming some mediclaim under the section 80D for rupees 25,000 rupees. So let us know how we can calculate the total taxable income for Mr. Raj. So for that, first we need to add all the heads of income from which the assessee is earning any kind of revenue. So first, income from salary 10,000. Here there is a loss of rupees 50,000. So we will deduct this particular amount from the total taxable income. Then we have a long-term capital gain of rupees 1 lakh, and then income from other sources are there. Then these all income will be added and deducted, and we will have a total income of rupees 11 lakh rupees from the different sources of income. Then we have a subtotal of all heads of income, that is 11 lakh rupees. Now the clubbing of income will be done. So wife's FD interest that we had discussed in the question itself, 30,000 rupees will be added in the income of Mr. Raj. Now after clubbing, the total income is 11 lakh 30,000 rupees. We had also discussed in the question that there is a capital loss of the previous financial year of rupees 40,000 which is brought forward to the current year, that is rupees 40,000. It will be deducted from the total income, and now the total income will be 10 lakh 90,000 rupees. We had discussed that some of the deduction in the LIC premium and the medical premium have been made by Mr. Raj, that will be claimed under section 80C and 80D. So a total of 1 lakh rupees and 25,000 rupees will be deducted from his income for the purpose of calculating his total taxable income. So after deducting the contribution to LIC and mediclaim insurance, the total taxable income of Mr. Raj for the current assessment year will be 9,65,000 rupees. Now, with the help of this gross total income of 9,65,000 rupees, according to the current slab rate tax system of the financial budget, they can calculate their total tax liability. So in this particular head, we had discussed about the various types of deductions from the section 80C to 80U, and now if you are filing your returns under the old tax regime and you are going to pay taxes according to the old tax regime, then you can claim all these deductions, as well as the salaried employees may also claim a standard deduction of rupees 50,000 for which the limit have been revised in the current financial budget and it has been extended to rupees 75,000 rupees. So if you will opt for the new tax regime, you will get the 75,000 rupees as standard deduction, whereas in case of the old tax regime, you will get a standard deduction of 50,000 rupees only. So I hope by knowing all these deductions and knowing about all these specifications related with the personal taxation in our country, you are now eligible to understand how you can minimize your tax burden, how you can plan your taxes and effectively can manage your total tax payment to the authorities, and you can maximize your savings also for their future investment. So with the help of all these discussion, I hope you must be having a clear idea related with the different aspects of personal taxation in India. With this, we come to an end of our lecture. Thank you.